Okay, let's dive into this. Welcome to This Explainer. Today, we are tearing right into the confusing and, let's be honest, sometimes completely chaotic world of heavy equipment financing here in Canada. If you're a contractor, a farmer, or running a construction fleet, pulling the trigger on your next machine is a massive capital decision. But the financing landscape, well, it's like a giant puzzle full of hidden traps, misleading numbers, and really complex rules. We're going to decode the insider playbook directly from the industry data so you know exactly how to structure your next deal like a pro. Right out of the gate, notice the massive gap here, 6.5% all the way up to 22%. That huge spread represents what Canadian contractors are actually paying for equipment loans right now as of June 2026. Just think about that for a second. You and a competitor could literally be buying the exact same excavator in the exact same week, but one of you is paying radically more for the capital. No way, right? How does that even happen? And more importantly, how do we make sure you land on the winning side of that math? So here is our 6-step roadmap for the explainer today. 1, the rate reality. 2, finding your lender category. 3, decoding rates and fees. 4, to lease or purchase. 5, the power of written agreements. And finally, 6, securing your best deal. Step by step, we're going to completely demystify this chaotic landscape. Let's start right in with section 1, the rate reality and the current Canadian market. To really understand what you should be paying, we first have to lock down the macroeconomic baseline. Everything in equipment financing starts with the Bank of Canada policy rate, which is holding steady at 2.25% as of June 2026. When that baseline moves, your equipment loan rates move with it. But how that baseline actually translates to your business? Well, that depends entirely on your credit tier. Take a look at this data. A good rate isn't just some flat national average, it's totally relative to your specific file. If you've got an excellent score over 750, you're looking at that 6.5 to 8.5% range at a major bank. But say your score is 640. In that tier, a 10.5% rate might actually be a fantastic deal for sure. You have to compare your offer against the right peer range, not just the lowest shiny number you see advertised. That brings us to section 2, finding your lender category. Where you apply absolutely matters most. You know, the single biggest mistake we see contractors make isn't applying for the wrong rate. Actually, scratch that. It's applying in the entirely wrong lender category right off the bat, getting declined and burning a really valuable credit pull in the process. And this brilliantly illustrates why that happens. Look at the stark contrast here. Big banks offer the lowest rates, but they move at a glacial pace. We're talking weeks to approve, and they strictly want 700 plus credit in newer equipment. Private lenders, they're the total opposite. They charge the highest rates, but they fund in a matter of days and are highly flexible on challenged credit and older private sale iron. Your job is to know exactly which box your file fits into before you ever hit apply. Within those specific categories, you'll generally be offered fixed or variable rates. Most heavy equipment financing in Canada is fixed rate. Why? Because as the saying goes, you are running a construction business or a farm, not a hedge fund. You absolutely need predictable, locked-in monthly payments to manage your cash flow against project revenues without sweating over sudden, unpredictable rate spikes. Section 3, decoding rates and fees. Time to uncover the true cost. Okay, we are entering the danger zone now. I need you to be incredibly careful here because a super low headline interest rate can be deeply misleading. Lenders are remarkably creative at making their upfront rate look tiny while casually making their profits somewhere else. Just look at this list of hidden traps. Documentation fees that can run up to $1,500, appraisal fees, broker fees, and prepayment penalties of 1 to 3% if you decide to pay off the loan early after landing a huge contract. Some lenders will even tack on charges for force-placed insurance if your policy happens to lapse. These fees are quietly, almost invisibly stacked on your contract. It's beyond frustrating to think you've secured this amazing deal only to get nickel and dimed on the back end. So it really forces the ultimate question here. What is your actual, true cost of borrowing? How do we cut through all this marketing noise? So the crucial point is you absolutely must demand the APR, the annual percentage rate. APR takes that stated interest rate and bundles all those sneaky hidden administration and documentation fees into one clear annualized percentage. It's literally the only way to compare lender A with lender B on a true apples-to-apples basis. A good rule of thumb: always calculate the total of all payments over the entire term minus the principal to find out what you're really paying. Section 4, to lease or purchase. Let's navigate the heavy math. This is the strategic decision that fundamentally alters both your business's balance sheet and your year-end tax bill. Let's break down the two main types of leases. On the left, we've got the operating lease, or fair market value lease. Here, you're only financing the machine's depreciation during the term. That means your monthly payment is way lower, and it's a big but, you just turn the machine in at the end. On the right is the finance lease, often structured with a $1 buyout. This acts just like a traditional loan. You are paying off the whole machine, so the payments are definitely higher, but you own the whole shebang outright at the end for a single buck.
And the tax implications for these two? Totally different worlds. With an operating lease, you fully deduct your lease payments as a standard business expense, and it stays completely off your balance sheet. Now, with a purchase or a finance lease, that asset goes right onto your balance sheet. You deduct the loan interest, plus you get to claim capital cost allowance, or CCA. For heavy equipment, like tractors or self-propelled machinery, that usually falls under Class 10, which allows a 30% declining depreciation rate. That can be a massive tax deduction in those crucial early years.
Section 5, the power of written agreements, your legal safety net. Listen, in farming and construction, we love our handshake deals. It's how business has been done for decades. But when it comes to six-figure heavy equipment, relying on a verbal agreement is an absolute recipe for disaster. Now, what's really interesting about a solid standard commercial lease agreement, like the one we see here from Edmonton Heavy Equipment Rentals, is how it clearly defines the effective date, the term length, the as-is condition, and exactly how the rent is calculated per diem. It takes those vague, abstract promises and grounds them into a legally binding, indisputable reality. A truly robust written agreement protects both sides with very specific clauses. We're talking rights of inspection, clear insurance mandates, and crucial default conditions. But you need to pay special attention to environmental liability. Imagine you're leasing a machine and a hydraulic line bursts, just spraying oil all across the client's job site. The lease strictly dictates who pays for that incredibly expensive environmental cleanup. You absolutely want that spelled out in writing. Finally, Section 6, securing your best deal. This is your action plan. Okay, we've got the data, we know the traps, and we understand the lease structures. Now let's build out your action plan to beat the system. Step 1, always check your own credit first using a soft pull so you know exactly which tier you're in. Step 2, gather 3 standardized quotes. And remember, insist on the APR and a full list of all fees. Step 3, build a simple side-by-side comparison table to look at them objectively. And Step 4, do all of this negotiating within a tight 2 to 3 week window. Why? Because credit bureaus group hard inquiries made in a short window as a single shopping event. That protects your score while you leverage those competing offers against each other. I want to leave you with this final, really important thought. The cheapest deal on paper isn't always the best deal for your business in the real world. Sometimes paying a slightly higher rate to a private lender so you can get a dozer dropped on site in 3 days is worth infinitely more than waiting a whole month for a bank just to save 1 measly percent. You have to look past the headline rates and factor in the speed, the flexibility, and the long-term tax implications. So ask yourself, what is the true cost of your next machine? Thanks so much for joining me on this explainer, and happy hunting out there.